Okay, chapter 13. In this section, we're going to talk about the initial concepts of capital structure. And in this case, we're going to concentrate on leverage and break-even analysis. So let's talk about leverage in general. Essentially, it refers to the impact that fixed costs have on the returns to investors. Leverage itself is another word for risk, right? It indicates risk. The greater the leverage, the greater the risk. So the higher the leverage we get, generally we should have higher returns. However, they will be, obviously, because there's a risk implication, more volatile. Capital structure is the mix of long-term debt and equity. So it is a picture, if you will, of the leverage position that the company has taken with respect to gathering funds. Operating leverage is that leverage that's really concerned with business risk. It looks at the relationship between sales revenues and operating profits. Financial leverage, another form of risk, obviously, just looks at the fixed costs associated with gathering money. It measures essentially what we refer to as being financial risk. It measures the relationship between the company's operating profit and earnings per share. So as you can see, these things kind of go down the line. The top one is sales versus operating profit. That's operating leverage. And the next one is financial leverage, is operating profit compared to earnings per share at the bottom of the statement. Total leverage is the combined effect of that. So it looks at the changes in sales relative to the changes in earnings per share. But it is this combined effect of these two basic decisions of management. That is, how to run the business risk, and how to finance the business, financial risk. Break-even analysis is a concept where we can look at the choice or the choices made by the company with respect to operating the company. That's operating leverage or business risk. The operating break-even point, then, is the level of sales that are necessary to cover all of the operating costs. At this point, EBIT is going to be equal to 0. So we need to find out some basic variables. We need some information, obviously, about the company. So we can break down part of the income statement into the operating profit piece. Sales revenue is designated as the price times the quantity. The fixed operating cost is this FC, and the variable cost is VC, variable cost times quantity. That formula obviously equates to the operating profit of the company. We need to develop then a formula that says at what quantity will the operating profit equal 0. So now we have the formula itself. Quantity, Q, equals the fixed cost in the numerator divided by the price minus the variable cost. By the way, this price minus variable cost is a common term, if you will, and certainly in the accounting world, and we refer to it as the contribution margin. But again, what would happen, do you think, if we look up here? What is the EBIT if the company had no fixed costs? Well, it's just the quantity times the contribution margin. As fixed costs increase, obviously EBIT decreases. So we can see that there is an impact of making financial decisions, operating decisions that employ fixed costs. A primary example of this might be, converting production facilities from primarily manual labor to primarily robotic labor. The fixed costs obviously have to be covered for the maintenance and the running of this mechanized workforce, if you will. So let's see how this example might work. We have fixed costs of $2,500. The cost per poster is $10. The variable cost is $5. So what's the break-even point? The break-even point per the formula is 500 units. Now, let's ask a very basic question. Can we do this obviously in a spreadsheet? And I've provided a spreadsheet that will help you with those calculations. It's called the break-even analysis worksheet. Now, the price per unit we put in there, here's $10, $5 for the variable cost, and the fixed cost of operations is $2,500. Again, we don't need this other information right now. We'll use that later when we start talking about the financial leverage. But the break-even in units, as you see here, is our 500 units. So what's 500 times $10? So obviously it's $5,000. What's 500 times $5? $2,500. So if you take $5,000 in revenue minus the $2,500 in variable cost minus the $2,500 in fixed costs, you ultimately have a break-even unit of 0. Now, we'd like to be able to show this in a pictorial form. And again, with this worksheet, we are provided with the break-even analysis spreadsheet that will allow us to graphically portray this information. So we have here, the red line here is the total cost. The revenue is the blue line. So where the total revenue equals total cost, that's the break-even point. You can see that's right at this $500 level. So what happens if variables change, right? What happens if fixed costs increase? If fixed costs increase, you would think that it would now be harder to break even, so the break-even point would go up. What if the sales per unit goes up? Well, if the sales per unit goes up, there'll be a decrease in the break-even point because there's more contribution margin. Likewise, if the variable costs increase, that means that the contribution margin is smaller. That will infer that we need to have a higher break-even point to get to 0 income. To move forward to talk a little bit more about the measures of leverage, we have what's referred to as the degree of operating leverage. And it has two formulas here. The formula here for sales, I mean, you really don't have this information, especially for publicly traded companies. You don't know what that information is. And quite frankly, for most companies, they don't have individual units, so they don't have, or individual products, so their product mix is a combination of things. It's very difficult to do this for a company that's publicly traded. But we can use financial statements. Now, this answer will sometimes give us some bizarre things because changes could be negative. And if changes are negative, obviously the degree of operating leverage is negative, and that creates some challenges with interpretation. But again, if you kind of go back, if a company doesn't have fixed costs are 0, then the degree of operating leverage should be equal to 1. More risk is implied as we incorporate or add more fixed costs. So here we take this company, right? This we've been talking about, and in this case we say the contribution margin changes from $5, the variable cost changes from $5 to $450, and there's an increase in operating costs from $2,500 to $3,000. What is the break-even point? What are the ratios that we need to know here, or the information we need to gather for a company that sells 1,000 units? So here's where we'll incorporate more information. We need $10 for the price, $4.50 for variable cost, fixed cost 3,000. But now we have the units of production. The break-even point is 545 units, but the degree of operating leverage here is 2.20. That is, it implies that there is financial leverage. Anything greater than 1 implies financial leverage, or operating leverage. The greater this number gets, the more risky it is for the company. That is, the greater variation or the distinction there is between sales and operating income as the units change. Financial leverage, again we talked about, is the risk or the effect of changes from fixed costs of financing. So any company that has interest on debt and or preferred stock dividends has financial leverage. So how do we calculate the degree of financial leverage? Again, we have a formula that we can use that's essentially equivalent to the sales feature. But again, some of this information we may have, some of it we may not have. But in this case, you can say, what happens if a company has never borrowed any money and doesn't have preferred stock? Then the degree of financial leverage is EBIT divided by EBIT. That equals 1. Again, we can use the financial statements to help us if we don't have this particular kind of information. So what does that look like using the spreadsheet? Oops, I'm sorry, I don't have that. Here we have using the spreadsheet, right? We have $5 per unit. The total variable cost $2. 10,000 is the fixed cost. Units of production. This is a $20,000 unit company. Interest expense is $20,000. Preferred dividends is $12,000. Tax rate's 40%. So the EBIT for this company is $89,990. Break-even units is 3,333 units. The degree of operating leverage is 1.2, greater than 1, so we know that there's some fixed costs involved. And the degree of financial leverage is 1.8. Again, recognizing that greater than 1 implies some risk. Now, what we need to now talk about, and I have these out of order, so I kind of apologize, is the concept of total leverage. What is the combined effect? And quite frankly, either of those formulas that we have here work, but what I'm interested in is talking about this formula here. The degree of total leverage is the total impact, but the important part here is the sign. The degree of operating leverage times the degree of financial leverage. The decision to use fixed costs for operations is an impact of business risk. Most companies really don't choose this per se. A steel mill typically can't decide to do more manual labor than it already has. It is a mechanized, capital-intensive industry. Some companies may, but most can't. So once a company decides what it wants to be, a steel mill, degree of operating leverage, for all intents and purposes, is going to be kind of defined for the company. But the company can decide how to finance operations. It's a conscious decision that they make. Now, what is the impact of that? Unfortunately, sometimes we don't use correct words. We say that, borrowing adds risk to the company. And that is really not correct, because it is a multiplicative impact. It is a magnification of risk and returns that we get when we finance operations. So I just wanted to make that point kind of clear, that the degree of total leverage indicates the magnification of the business risk by making choices about financial risk. And again, we have the concept where we have this company, and you can see here the total leverage is 2.16, which is ultimately obviously greater than 1. So it means that there is a fixed impact or an influence of leverage on this company. Now, what I'd like to do is just take 1 minute real quick and look at the spreadsheet. Here's the spreadsheet that you can find, and that we can input various kinds of information. And what I want to kind of do is just go through the discussion of the variables. Here are the variables we've been talking about so far, where you can input information about the income statement, units of production, interest, dividends, and that calculates these degrees of operating leverage over here. However, from time to time, you don't have that information, especially for publicly traded companies, so we might ultimately have to use this information over here, which is the changes in earnings per share, the changes in EBIT, and the changes in sales. And that will help us to develop the degree of operating leverage, financial leverage, and the degree of total leverage in those boxes. The other thing that's added here, of course, is I've given us the graph that helps depict the relationships between, here's fixed costs, here's the total revenue of the company, here's the total cost. So a question is, well, what happens to this graph when I change? And let me do this real quick. Let me hide these so we can see everything all in one thing. Let me hide these rows. I'll hide those rows. Oops, okay, didn't like that. I can't do that, so I can't hide them. So let me do this. It'll help us with this. Click on here, and let's do a view and split the view. That will help. And because what I want to do is I want us to have a picture or a view of the graph as we change some of the variables. So let me just put this down once we see. So we had the fixed costs are $2,500. So what happens when fixed costs increase? So fixed costs increase from $2,500 to $3,000. So if I change from to $3,000, you're going to see that the variable cost curve jumped upwards, right? Here, excuse me, the fixed cost curve. The total cost curve also increased. That moved the break-even point here from 500, moved it over to 600. Let's move back to $2,500. What happens if the variable cost per unit decreases? We figure out a way to make the product less expensive. What's going to happen to the break-even point? If you look at the break-even point, the total cost curve dropped, so that means that instead of 500 as the break-even has moved over, and it's now roughly 384 units. In addition, again, going back, we can look and see, well, what happens if the price per unit changes. Let's say that the price per unit, there is competition comes in and we have to reduce it by $2. How does that impact break even? You see, break even was 500, right? Now it's, excuse me, the break even point here, I reduced this price to 50. So we now have a break even point of 454 units. Okay? So we can see as you change the variables, as you change these variables, it has an impact on these graphs that ultimately help us define what is the break-even units for a particular company.